Thank you. Appreciate that. Thank you also for having us and giving me some time to speak to you about disability income, or as we like to call it now, income protection, right? We take some negative connotation out of that name of disability income. I have been with Ameritas for 25 years. We have been selling disability insurance for 68, so we know a thing or two about it, and we are in what would be considered one of the top 6 DI carriers in the country. So let's go ahead and get started. Right? The mantra of any financial services, grow and protect, right? So growth is always dependent on the stability, and we're really not able to predict health from day to day, right? We know we're going to die, but we don't know if we're going to become disabled or when we're going to become disabled. Chances are you're going to become disabled before you're going to die. So disability income becomes an essential part of all these comprehensive protection plans that you guys are putting together for your clients. Because as there's many people have said, if you're not having any income coming in, what are you planning for them? What are they going to give you to invest and put into these IBC policies, right? And an unexpected health change can affect their ability to work. So again, that's why having an income protection plan in place can maintain their lifestyle, they can pay their bills, they can stay in their house while they're dealing with probably one of the worst things to ever deal with is being disabled. A lot of clients will have the objection, I'm covered through work. Well, yeah, that's great. They got a group LTD plan provided by their employer. They pay the premium for it, offers them a little bit of benefit. But what they don't understand is their benefits are limited. Most LTD plans cover 60% of a client's salary, and it caps out at a certain amount. Typically, it's $10,000. Depending on what type of occupation it is, sometimes they go higher than 10. So with that, number 2, that benefit's going to be taxed because it's employer paid. So it's paid with pre-tax dollars. So when they start getting their disability benefit, Uncle Sam's going to want a piece of it. They're going to, hey, we didn't get that. So really, let's not say 60%. Now let's think more like now I'm getting 40% of my salary because I'm going to hold back 20% to pay taxes. 3, variable incomes are not covered. Typically, group LTD plans cover base salary only. Everybody here is in sales, right? I'll admit it, I have a sales bonus component in my salary. My group LTD plan is not going to cover that. It's just going to cover my base. So I bought my own disability policy to help cover those extra income. Lack of portability. If I leave my employer, if I leave Ameritas tomorrow, I don't have a group policy because it stays there. It doesn't go with me. My policy follows me wherever I go. So we call it income protection. Also think of it as asset protection, right? We're protecting somebody's most important asset is their income, their ability to earn. So when you talk about asset protection or income continuation plan, start with their current spending, expenses, savings, and long-term goals. You're already doing that when you're talking to them anyway, right? So you already have that information, but make sure you get that information. Then you want to design a policy that protects and make sure that it involves the understanding of the impact to their expenses if they lose their income. Let them know, hey, it's great that you have a savings, but you're going to blow through that immediately. It's not going to last. It may have taken you years to build it up. It's going to be gone in months. And as a carrier, I can't protect everybody for the long term. And for many clients, we walk them through how much they may need, how soon they can receive the benefits, and how long the benefits are going to pay. Right? That's our job. So I know, right, people are talking about, I'm going to say a bad word, 401k. We've said it many times in this room. Younger clients are now focused on saving for their retirement. Gen Z, 2/3 of Gen Z workers, 66% are now saving through retirement through a 401k. And 78% of millennials are saving for retirement in a 401k plan or similar. Gen Z households have 2.5 more times more assets in their disability continuation plans than Gen Xers had when they were at the same age. So these are, real-time statistics. So what's the default income continuation plan? If I become disabled, what's my first thing I'm going to do? All right, I'm going to try and live on my savings. Again, that's going to be exhausted to a point. What else am I going to do? What else is probably a huge, I don't have an IBC contract, right, policy. I got a 401k through my employer that has a whole lot of money just sitting there waiting for me when I retire so I can enjoy my retirement with my wife and my family. I'm going to dip into that. So we're going to take a look at a scenario that's going to show you how that really can affect a retirement plan. Our person is a 40-year-old professional. They have a $200,000 income. They have a retirement savings balance of $400,000. Annual savings of $10,500. That includes a 3% employer match. Annual inflation income increase 1%. These numbers are a little bit behind the times, but savings increases 2%, and they have an investment return of 5.5%. So if we look at this slide, client plans to retire at age 67. They have an account value of $2,459,000. And they will roughly draw 3% of that, or $75,000 per year. With a little more coming out each year, right, due to inflation, they want to make sure that they can keep pace with inflation with their retirement. And they're looking at a 2% investment return. As you can see, this is going to take them to age 101, and they'll still have a balance of $492,000 in that plan. Now, what happens if there's a disabling event early on? Client has a health issue at age 44, causes him to take 15 months away from work. Now he's not putting any money into that 401k. He's exhausted his savings. He now has to resort to pulling out $231,000 from his 401k plan. And then after all the penalties, he's really left with about $208,000, about a year's worth of salary for him. And assuming everything else stays the same as the previous slide, this plan is going to run out of money at age 85. Now granted, hopefully they live to age 85, who knows, right? Life expectancies are getting longer and longer. But that's a huge, huge chunk of that person's retirement. So we look at year one, right? The first line, right? Back to the Future 2, that's 1985. Then we look down below the gray line. That's the alternate timeline where we had that health event at age 44. And as you can see, it resulted in an $895,000 loss in that retirement plan. So it's kind of hard to see. The yellow hash marks are the retirement plan paying out. The blue is retirement with no withdrawal. So as you can see, age 87, 90, around there, no more money's coming out of that plan. Now the client doesn't have any money to live on. Same scenario, however, the health event happened at age 54. So still takes the $630,000 loss in that plan. It lasts a little longer, right? You're probably getting to around 94, age 94 before it really starts to run out of money. So an asset protection plan that provides risk mitigation at moderate cost, right? A disability policy, roughly 1% to 2% of your salary. And you don't have to have the bells and whistles. But again, if you know what the client really needs as far as monthly expenses, that's the important part. This type of plan reduces the chances of retirement funds, right? The withdrawal due to the unexpected health change. So when you add a disability policy to the retirement plan, you're going to provide more comprehensively protected assets. So here's the solution. All the variables remaining the same with those previous slides. The client's taking $3,000 from that retirement contribution and funding a disability policy or income protection policy. At age 67, that balance is $2,241,000 versus the $2,459,000, 9% less than what it was previously. To me, 9% is worth making sure that I can retire and enjoy my retirement and not have to worry about my plan blowing up. Still ends up at age 101 with a balance of $57,000 there, as opposed to zero. Obviously, it's not ideal, but it's a much smaller cost to the client versus letting them see their 401k get depleted. Again, focus on the benefit provided to the retirement plan. We can position the disability insurance as an investment option to them. The premium can now be demonstrated as to diversify the risk that is involved with that. And again, while the chances of disability are low, the impact of a withdrawal is high, as we just seen. I'm going to talk about our disability portfolio. We have some products that are available. Our new product, Jim alluded to it, we launched it last year. Also, our sales for 2022 were $18 million. We did $23,500,000 of DI last year. Huge increase, all due to this new product, Dynamic Cornerstone. We have two plan options or contract types, a non-cancelable, right? So I buy a non-cancelable policy, my premium remains the same throughout the entire life of the contract. We also offer what we call a guaranteed renewable contract. What that means is all the same bells and whistles of a non-can, but the carrier reserves the right to raise my premium on a class basis or an occupation basis. If we as a carrier start seeing we're taking huge losses in salespeople, right? Me raising my hand, so now they're all of a sudden going to say, we're going to have to increase your premiums on that. What would happen is we would close down that block, and on the new block, we would increase the premium. I believe so much in guarantee renewable that that's what my policy is. I've saved some premium dollars because of that. I don't have that premium guarantee, so that affords me some premium savings here. Dynamic Foundation, that is our older product. That is still available in certain states, and we'll talk about that here in a second. These names are not, you notice our old product was called Foundation, right? What have we said all along? The income is the foundation to everything, right? Our new product, Cornerstone, a strong cornerstone, helps make the foundation stronger. We also offer business overhead expense for business owners. In case they become disabled, that helps them maintain their lifestyle, or helps them maintain their expenses in their business so they can keep the doors open, keep their employees paid. And then we also have a guaranteed standard issue program. Jim alluded to that earlier, so we'll talk a little bit about that. White, gray collar target market. Average income, $75,000, and sweet spots, ages 30 to 50. We will issue coverage up to ages 64, but sweet spots are ages 30 to 50. Professionals, accountants, engineers, architects, CPAs, attorneys. Physicians and dentists. Our product is very strong in the physician market space. It makes up probably about 45% of our total block of business. So physicians are low-hanging fruit, as we call them, because they know they need it. When they're in residency, they're getting that pumped into their head from their attendings that they're learning from. Agents are always calling on them. So that's a pretty easy market to get into. However, I would challenge you to go after those professionals as accountants, as engineers, the IT field. We do need more of those. And their income is just as important as the physician's income is. Business owners, right? Sole proprietors, partnerships, corporate executives, managements, and sales. Does anybody have a disability policy on themselves? Yep. Good. Because you can't understand it until you own one, right? So that's the easiest way to know. If you don't have one, I encourage you to get one. These are the states that the Cornerstone product is approved in. You're going to notice California, New York, South Carolina, North Dakota, South Dakota, Wyoming are not yet on here. Florida did just get approved, so it is there. We are working on getting New York approved, and South Carolina, Wyoming, those other states should fall in line soon. California is going to be the outlier, right? It's very difficult to get things done in California from a filing standpoint. Definitions of disability, probably the most important piece of a disability policy, because this actually drives how a claim would be adjudicated. We offer three. The first one's going to be what I call the double cone, right? You're getting 2 scoops. If I have that definition right there, that number 1, and I can't do my occupation because of a disability, I'm going to get my benefit from my Ameritas policy, but I can work in another occupation. Maybe I can sit in a store in Walmart and say, welcome to Walmart. I'm going to get paid by Walmart, and I'm going to get my benefit from my Ameritas policy. Physicians love that. Also, your white collar, all of your professionals, they're going to want that definition because they want to be able to have the best protection that they can. Number 2, exact opposite of that. If I have that definition and I choose to work, I'm not going to get my benefit. And then number 3 is kind of a hybrid. So for the first 2 years, it offers a known occupation protection. And then after those 2 years, then it becomes any reasonable occupation for the remainder of the benefit period. And you're going to notice there's an asterisk. So in Florida, there's actually a state variation where that second definition of disability is a 12-month ONA. Policy provisions. These are built into our policies that cost the client no premium dollars. Most carriers have these, except you're going to notice 3 in red. Those are unique to Ameritas, industry exclusive, as I like to call them, or tiebreakers when I'm dealing with a competitive situation. First one's benefit advancement. If I have my Ameritas disability policy and I'm walking out here on a parkway and I sprain my ankle, I go to the ER, get it wrapped up, I get some painkiller, some Motrin, whatever. I'm going to get billed for that. Well, I remember I got my Ameritas policy. I'm going to fill out a claims form for that, and I'm going to send that in. They're going to give me $500. They're going to put money in my pocket because of that. Same if there's a damage to your natural teeth, right? Christmas time, hard candy, right? I love hard candy. If I'm eating hard candy, I bite down too hard, crack a molar, going to the dentist, guess what? Ameritas is going to give me $500 for that as well. That's a per occurrence benefit, doesn't run out, and it does not affect any other provision of this policy. Second one, good health benefit. Do we all know what an elimination period is? Period of time, right? You got to wait before you get your money while the carrier decides, okay, we're going to approve your claim. That good health benefit will eliminate 2 days off that elimination period for every year you're not taking a monthly benefit. And I'm not talking about that benefit advancement. I'm talking about a monthly benefit from the actual policy itself. 90 days is the typical elimination period that you see. I've had my policy in force for 10 years. Everything's been great. All of a sudden, year 11, I have some type of disabling event. Well, instead of a 90-day elimination period, I now have a 70-day elimination period. So that's going to help me get my money that much faster. Yeah.
And think about that, like, you know, I mean, it may sound like a big deal, but, you know, if people become disabled, they don't have their income, they need that payment, or you can hand them a check, you know, 20 days earlier than what they were expecting. It's a big deal at that time. So it's something that you really, you know, it doesn't sound like a big deal, but 20 days earlier when they're needing that funds so bad, it's really a big deal.
Yeah, absolutely. No other carrier is going to offer you that type of a benefit built in. The last one, this is really going to come into play if you're working with a client that maybe works in an office or some type of employment situation. They carry their health insurance for their family or themselves. Well, they become disabled, and its chances are they're not going to recover. You know, usually the employer-employee kind of separate. Well, now they get a letter saying, hey, you want to continue your health coverage? Here's your Cobra Health Premium. I don't know if you guys have ever seen those. They're outrageous.
Yes.
Now I'm freaking out, right? I'm probably going through one of the worst periods of my life. I got a family. I carry the health coverage. Well, my Ameritas policy, I'm going to remember, oh, I have that Cobra Premium benefit built in. Ameritas is going to send me $1,000 per month for up to 18 months to help cover that premium for my Cobra insurance. And that starts from the first premium due. So not only are we giving you $500 of benefit advancement, if you run into a Cobra situation, we're going to give you $18,000. I think the beauty with our product is the customization that you can do. So here are all of our riders. We have 3 residual riders. You know, residual rider, I can only work part-time because of the disability. I'm going to see some loss of earnings. That's what those riders do. Those help make me whole during those periods of partial or residual disability. Social insurance rider, that offsets for social insurance or social security disability. You can kind of design a policy if you want to help the client save some premium dollars. That pulls the premium down some. We have inflation riders, cost of living. We have 2 of those, 2 to 6% compounded or 3% compounded. Those are based on the CPIU. 90% of the time, we're quoting the 3%, but the ability to do 2 to 6, just understand that 2 to 6 is going to be a little bit more expensive for your client. But if that's what they need, then that's what you should illustrate. We have 3 increased riders on the right. Hopefully their salaries are going to increase as they work in their career. And if you get them young, they most definitely will start making more money. That's what those riders do. Those help keep the benefit in pace with the increases in their salary. Catastrophic disability. People mentioned 2 out of the 6 activities of daily living. That's what that rider does. If the client has those, suffers those, or has a severe cognitive impairment due to brain damage, that rider pays an additional monthly benefit to them with the policy. Student loan and also a lump sum savings. Again, we're talking retirement. That rider is designed to help recoup any lost retirement if a person does become disabled. They're not putting any money into a 401k or any type of investments. That's what that rider does, pays them a lump sum at age 60, equal to 25% of all qualifying payments that we paid out to them. Business overhead expense, Small business owners, 25% or less manual duties. Medical, dental professionals. Dentists buy business overhead more than any other occupation out there. So if you know dentists, I'd talk to them, ask them. Small business market, includes attorneys, accountants, architects, CPAs, insurance professionals, IT consultants. Contact your local chamber of commerce. They may have give you some contacts with small business owners. If you don't have any, just kind of a sales idea. And pretty much the majority of small businesses, they have no income protection or disability protection. So again, if you ask a small business owner, hey, can you take 30 days off of work? They're going to look at you like you're crazy because they're going to say, no way. My business is going to close or fail if I do that. Then that's kind of your key into it. Let's talk about business overhead expense. What would you do if you became disabled? The other thing that this does is this policy keeps the business open. And let's say, client's not going to get better. They can then sell that business. They're not going to lose any equity in it. They're going to keep the business open. It'll still be profitable. And then they can sell that because of that BOE policy they had. Benefit period, you're going to see the longest benefit period is going to be 24 months. Typically, if a business owner is not going to get better within 2 years, they're looking to get out of it anyway. Again, they're going to sell it, keep all the equity. Some riders, salary substitute, they can have that rider on. What it does is it helps cover the cost of bringing in a substitute to do their job while they are disabled. Again, think dentist. If a dentist goes out, they can bring in another dentist to help work and keep their practice going. Future increase option to increase their benefit. Extended residual, and then business loan repayment, right? Everybody has probably business loans at some point. This rider helps cover those. Up to $2 million will cover for business loans. Dynamic fundamental. So those last two products, white collar, professional marketplace. So now you're saying, Todd, what about gray, blue, or homemaker? Well, that's where the dynamic fundamental product comes into play. Pays a single lump sum benefit up to $100,000, right? 1 times their annual salary. If they become disabled, it's going to be expected to last a year, and they survive those first 30 days. This pays them a lump sum benefit. There's also 3 riders that they can add to that policy to make it a little bit more valuable. There's an accident only, a catastrophic disability, and a critical illness. Critical illness, think about that as like the Care for Life rider, but it's on the disability policy. Guaranteed standard issue. So guaranteed standard issue is a program where it's simplified underwriting. It's guaranteed standard issue. So if you go through this program, maybe you're working with an employee benefits shop or maybe you have some contacts there. You're working with an employer. They want to make sure that they can retain and reward their highly compensated executives. If they have a group plan, because as we spoke before, if they have a group plan, it's capped out and they're not going to see very much benefit out of that. So a guaranteed standard issue program can be placed on top of that group LTD, and it can supplement the additional loss of earnings. The producer, right? You can process multiple contracts, minimal underwriting, great cross-selling opportunities. The commissions are strong. They're 100% vested. There's no threat of commissions going to another agent, right? We will vest that program to you. The employer, it's a perk for the employees. Like I said, there's highly compensated individuals. The case design's flexible. We look at for classes of employees, product options, plan options, et cetera. You can design the plan to meet the needs of the employer. The employee, they get a discounted policy. They own it individually outright. If they leave that employer, they take it with them. We don't take the discount away. Again, you supplement some group long-term disability coverage that they have with a individually owned policy. No medical underwriting. What we're looking for here, there's 5 gatekeeper questions on the app. Have you ever missed work in the last 6 months? Do you have any ADL issues? Are you severely do you have any cognitive issues? Financially, all we need is a census with the employees' names, date of birth, genders, and their salaries, including any bonus. Why do I say genders? Because we look at this as kind of like a group underwriting product, so we have to make sure that there's a good mix. If there's too much one way female, unfortunately, that females have actuarially been proven that there's certain things that can happen to them that can't happen to a male that could cause them to become disabled. So carriers kind of look at that. We would be no exception to that. Complete the RFP, request for proposal. It's a simple form. Tells us how you want that program designed. And then again, we just need the census. A couple things I want to talk about. I don't have slides for these, so if you want to write it down. We talked about renewals. DI offers strong renewals. We'll pay out 50% first year commissions. And then years 2 through 10, we offer 10% renewals on that business, as long as it stays on the books and it'll follow that block throughout the entire process. In addition,
it's the strongest renewals I think we offer.
It's
more.
Yeah, absolutely.
So it's building a consistent long-term income, renewals off disability income are unmatched.
I know producers that roll out of bed on January 1 and they're already millionaires because of the renewals, right? They've done that much business. The other thing we do offer is a bonus program for the renewal. And Scott, I'll send you a flyer so you can share this with the individuals, your team. So if you hit a threshold of $35,000 of premium in 1 year, you're going to get an additional 5% on that business. If you sell $75,000, you're going to get an additional 10%, right? So then your renewal ends up being 15% or 20%, depending on where you hit that year. Any questions? I limited the time, so I know I went through a lot of stuff, and yes.
And you may have mentioned this because I didn't really have to come up with With like more what we would consider blue collar jobs, are they just higher rates because of disability? Is that the reason why you
Risk.
said for us that, yeah?
Yeah, so great question, Brandy. You look at life underwriting mortality, disability is morbidity, right? You and I, we sit at a chair, we're behind a computer on a phone. We're less chance of getting hurt during our occupation. You got a plumber, you got a contractor, things could happen on the job, right? Truck driver, right? There's certain, so yeah, with the risk inherent with the jobs is kind of where we decide to place them, so.
So it's not that they couldn't get it, it's that they would end up having to pay higher premiums if they got.
That's where that fundamental policy comes into play, right? Because that's a very inexpensive product for them. They could buy the cornerstone product, but then, as Brandy mentioned, it's really expensive when you start getting to those really more manual jobs, et cetera.
So the best one for a 1099 employee, like if I'm writing a fellow insurance agent or something, if I'm just writing them.
Cornerstone.
The cornerstone. Okay.
We'll do 1099.
Okay. And then also, how does that coordinate with, if they're on a group plan already, how would that coordinate?
Good question. Every carrier has what we call issue and participation limits, right? So we're looking at your salary. We'll offer you this amount of coverage. If you have other individual coverage from like principal or standard, we look at that. And then if they have a group plan, we also look at that. So currently right now, we'll issue up to $30,000 of coverage, base coverage, and we'll participate with both individual or group LTD up to $35,000.
Okay, so participation. So I was just wondering how we can leverage that, because you were saying that a lot of people say, oh, I've got insurance. I've already got insurance. I don't need to work. But how would we, like, what would be the rebuttal for that?
I would say, hey, okay, that's great. Don't make it seem negative. Say, hey, that's awesome that you have that through work because that's a great start. But did you know that you're going to be taxed on that benefit? So really, instead of 60%, you're only going to end up 40 or whatever it would be, right? Let's go ahead and supplement that with an individually owned policy, because if you leave that employer, you're not going to have that group policy, and then you'll be stuck and you won't have anything. Does that answer your question? Yeah.
Use our policy to supplement and get almost, fill that income gap, right? Almost get 100% coverage.
Well, in certain situations, absolutely, yeah. Yes, sir.
Also, it needs to be noted that you're replacing income.
Not
You're
my
ensuring your ability to work as their income.
Yeah.
You're also, when you do these renewals, you're also ensuring your own income as an insurance agent. Okay, so you could have $1 million in renewals coming in a year if you build the stuff up over time. So if you ever think about retiring from the insurance business, you live on this. So you can't disabled, you can't sell insurance anymore. You got your renewals coming in. So everybody needs to protect their income. Protect your car, your house, everything else. You protect your income. Really, protecting your income. If you recover from a house fire or towing your car, the most important protection you can have is your policy.
Absolutely.
True.
Yes, sir.
I'm sorry to walk out, but maybe someone asked this question, but as it relates to with people who have employer-paid coverage and they want to get supplemental coverage on top of that. So let's just say it's an average, just Joe, white-collar worker. Up to what percentage of their income would Ameritas consider like 80%?
It could be, yeah, right. So like Chris kind of alluded to that also. It just really depends on the situation, how much money they're making, right? Because last night we talked, and on that income scale, typically you hear 65% replacement, and I think agents get fixated on that. But really, when you look at the carriers and their income and their issue and participation limits, I have charts for all the carriers, right? So I know where we're all at. When you really start looking at those and those salaries increase, that ratio that we will supplement really shrinks. But I've seen 85% replacement. Just again, it really just does depend on the situation. I also brought some handouts that I got over there and some business cards. We're kind of in influx right now with the sales desk and DI. We're down 2 internal wholesalers, me being one. So we're actually hiring for 2 new ones. I would encourage you, if you have any questions or you want to follow up discussion or more in-depth product training, give me a call, shoot me an email. I'll be glad to do that with you. And then once they get a replacement for your area of the country, we'll do introductions and everything. So any other questions? Or Yes, ma'am.
I know it's called key man insurance, like if you were gonna do something different, but I was gonna ask him, like, say my sister is the main office person at her company. Could I talk to her boss and say, you understand, can you put out disability that pays out to the owner is what I'm asking?
No, I knew that's where you were going, yeah. We just don't have a key man, and I'll tell you why. The market share for that is so low that there's really only 2 carriers that offer it. For us to develop that product and the recouping of the cost, it would take forever. All right, well, thank you. I appreciate it. Hopefully you learned something.